If you're over 70 and you've got money in the bank, I need you to listen very carefully. Because from this September, HMRC is rolling out new rules that could give them unprecedented access to look at your bank accounts, your savings, and even your pension income. And here's the part that's worrying everyone. If you've got savings interest or income from a private pension, you could suddenly find yourself being dragged into the self-assessment system for the first time in your life. Imagine being 75 years old, never having filled in a tax return in your life, and suddenly a letter lands on your doormat from HMRC telling you that you've got to file one. That's exactly what's happening right now to thousands of pensioners across the country. Now, I know what you're thinking. I've paid my taxes all my life. Why would they be coming after me now? Well, it's not about targeting you personally. It's about a massive new data gathering push that's going to see HMRC receiving ongoing information from banks and building societies about your accounts. They're not just looking at big earners anymore, they're looking at everyone. And if your savings interest is over £1,000 a year, or if HMRC thinks there's a discrepancy between what you've declared and what the banks are reporting, you could be in for a nasty surprise. Before we dive into exactly what these new rules mean for you and your money, make sure you hit that like button. It really helps the channel, and it means you won't miss any of the other crucial updates we've got coming. Now, let's get into it. Because if you're over 70 and you've got savings in the UK, this is one of the most important videos you'll watch this year. So, what exactly is changing from September? The short answer is that HMRC is getting new powers to gather data from banks and building societies on an ongoing, continuous basis. Up until now, they could only request this information on an ad hoc basis. They had to have a specific reason to ask your bank for details about your account. But under the new legislation, contained in Clause 252 and Schedule 22 of the Finance No. 2, Bill 2025-26, HMRC can now impose a standing obligation on banks to provide data on an ongoing basis. This is a fundamental shift in how the tax authority operates. They're not just looking at people they suspect of wrongdoing anymore, they're building a massive database of financial information that covers millions of ordinary people. Now, I want to be very clear about what this means for you. The Low Incomes Tax Reform Group, which is a respected independent charity, has raised serious concerns about this legislation. They support the principle of using third-party data to help people get their tax right, but they've warned that there need to be proper safeguards in place. They're worried about what happens when the data is incorrect, and whether you'll have a clear way to challenge and correct any errors that appear on your file. And the truth is, mistakes do happen. Banks make errors. Data gets misreported. And if HMRC's systems show that you've got income you haven't declared, you could face an investigation, a tax bill, or even a penalty, all through no fault of your own. But here's where it gets really specific for pensioners. We're already seeing reports of older people, many in their 70s and 80s, receiving letters from HMRC telling them they need to complete a self-assessment tax return. And a lot of these people have never had to file a tax return in their lives. They've been PAYE employees, they've got their state pension, and maybe they've got a small private pension or some savings that generate a bit of interest. Previously, HMRC would just calculate any tax you owed from the information they got from your bank and your employer, and they'd adjust your tax code or send you a P800 calculation. But that seems to be changing. According to reports from accounting professionals, pensioners who are within the basic rate threshold, but with savings interest over £1,000, are being told they need to register for self-assessment. Why? Because HMRC is now actively trying to close the tax gap. They're using the new data gathering powers to identify people whose tax affairs are simple, but who might have underpaid tax in the past because not all their income was reported. And if you're in that position, you could suddenly find yourself facing a filing deadline and the stress of dealing with HMRC forms for the first time. Now, let's talk about the specific risks for pensioners with savings. You need to know about the savings allowance. For a basic rate taxpayer, the first £1,000 of savings interest each year is tax-free. For a higher rate taxpayer, it's £500. If your savings interest is above that threshold, you might owe tax on the excess. And HMRC is now much better at tracking that interest because of the new data sharing rules. They're getting reports from banks about how much interest you've earned, and they're cross-referencing that with your tax records. If there's a mismatch, they'll be sending letters. And if you ignore those letters, things can escalate quickly. And then there's the winter fuel payment situation. This isn't a bank rule in the traditional sense, but it's going to affect your bank balance from September, and it's tied to the same data sharing systems. From this winter, the winter fuel payment is being paid to all pensioners automatically. But if your individual taxable income is over £35,000 a year, you'll have to pay it back through the tax system. Now, the key thing is that HMRC isn't going to take this money directly from your bank account. Instead, if you're a PAYE taxpayer, they'll adjust your tax code and take it out of your monthly pension payments. If you're in self-assessment, they'll add it to your tax bill. But here's the thing, if you don't want to receive the payment at all, you need to opt out before the September deadlines. That's the 18th of September if you're doing it by phone, and the 20th of September if you're doing it online. Miss those dates and you'll get the payment, but you'll have to pay it back later. For some people, that could mean deductions of up to £600 across the next 2 tax years, because HMRC will be collecting 2 payments at once. Now, I know a lot of you will be worried about HMRC having the power to take money directly from your bank account, and yes, they do have that power. It's called Direct Recovery of Debts, or DRD, and it was first introduced in 2015. But I want to reassure you about how rarely it's actually used. Between 2016 and 2018, when the scheme was first active, it was used only 19 times in 2 years, even though HMRC estimated it might be used 11,000 times a year. The safeguards are incredibly strict. HMRC can only consider DRD for debts over £1,000, and only after all other recovery routes have failed. Before any money is taken, HMRC must make a face-to-face visit to confirm they're dealing with the right person, assess for vulnerabilities, and discuss other payment options. They must leave at least £5,000 untouched across all your accounts, and they must issue a formal 30-day notice before any money is taken, giving you time to appeal or set up a payment plan. So, the power exists, but it's a last resort. It's not something that's going to happen to ordinary pensioners who have a small amount of savings and who are paying their tax correctly. But the important thing to remember is that HMRC now has the ability to check your bank account information without telling you first. Under the Financial Institution Notice rules, HMRC can ask your bank for records without your explicit permission, as long as an authorised officer has approved the request. In some cases, a tribunal can agree that telling you in advance could undermine the investigation, so the bank may be asked for records without you seeing the request first. That's a significant expansion of HMRC's powers, and it's why you need to be so careful about keeping your tax affairs in order. One of the things that's causing a lot of confusion and anxiety at the moment is the increase in HMRC-related scams targeting pensioners. We're seeing a perfect storm of confusion, with changes to winter fuel payments, new data sharing rules, and delays to tax refunds all happening at the same time. Fraudsters are exploiting this uncertainty, sending texts and emails claiming they can speed up refunds or process payments. But I want to say this very clearly. HMRC will never ask for your bank details via text or email. If you receive a message claiming to be from HMRC, don't click any links, don't reply, and don't share any personal information. Always go directly to the official gov.uk website to check your position. So, what should you do to protect yourself? First, make sure you know how much savings interest you're earning each year. If you're over the savings allowance limit, you may need to let HMRC know. Second, check whether you need to register for self-assessment. If you receive a letter from HMRC telling you to do so, don't ignore it. You need to respond within the time frame they've given you. Third, if you've received the winter fuel payment in the past and you know your income is over £35,000, consider opting out before the September deadlines. Fourth, stay vigilant against scams. Always verify the source of any communication claiming to be from HMRC. And fifth, if you're unsure about any of this, seek advice from a professional or from a charity like Age UK. The new September bank rules represent a significant shift in how HMRC operates. They're using technology to gather more data on more people than ever before. And while the goal is to make the system fairer and to close the tax gap, there's a real risk that ordinary people, especially older pensioners who have always paid their taxes correctly, could get caught up in the system. The key to avoiding problems is to be proactive. Check your tax position now. Understand your savings interest, know whether you need to file a tax return, and make sure you're not ignoring any letters from HMRC. And look, I know this can feel overwhelming. The system is complicated, and it's getting more complicated all the time, but you don't have to deal with it alone. There are organisations like Age UK and the Low Incomes Tax Reform Group that can help you understand your rights and obligations. And if you're worried about a specific letter or a specific issue, don't panic. You have rights. You have the right to challenge HMRC's decisions. You have the right to appeal. And you have the right to request a payment plan if you owe money and can't pay it all at once. If you've already checked your savings interest or you've received a letter from HMRC about self-assessment, drop a comment below and let me know. I read every single comment and I'm here to help. We're a community here and we look out for each other. So check your savings, check your tax position, and know your rights. It's your money and you deserve to know exactly what's happening with it. Take care of yourselves and I'll see you in the next one.